Hey everyone, welcome back to Corporate Decoder. Today we're diving into FS Bancorp's latest financial report, and let me tell you, it's not exactly a thriller, more like a community bank's version of spring cleaning. We'll see if they manage to tidy up or just shuffle things around. This report gives us a peek into how FS Bancorp, a Washington-based community bank, performed over the first 3 months of the year. Think of it as a snapshot of their financial health, from their profits to their potential risks. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us. First off, this is their Form 10Q, which is basically a quarterly checkup for publicly traded companies. It covers everything from their balance sheet to any potential legal troubles. It ended in March, so it's pretty recent. FS Bancorp has been around a while. Their commission file number says 2011. This bank has been around a while. You might know them as First Security Bank of Washington, which is their main operation. They've got almost 30 branches scattered around Washington and Oregon, and they focus on serving small businesses and local folks. They had about 7.7 million shares of common stock floating around. Keep that number in mind. It'll be relevant when we talk about earnings per share. Let's get into the numbers. The first key number is their assets. So their total assets ticked up slightly to $3.7 billion. Looked like they made a slight financial reshuffling where they moved money from certificates of deposit to interest-bearing deposits. Seems like they are betting on interest rates going down. Loans are at $2.5 billion, virtually unchanged since last quarter. Deposits are at $2.6 billion. This seems like a big deal and maybe where they will get a lot of future growth. Their subordinated debt, or bonds if you will, which are higher interest paying obligations, were unchanged at $50 million. The additional paid in capital, which is essentially money raised from stock sales, decreased, so they diluted investors a little bit during the quarter, but not by too much. And their accumulated other comprehensive loss, a mouthful, I know. This loss, which decreased, relates to their investment portfolio, so they made some money, or at least staunched the blood here. Now let's get into profits. We'll look at what makes up the statements of income. Their net interest income, which is like their bread and butter, in financial terms is the spread they make on loans, increased to $30.9 million Thai. It seems they are handling the high interest rate environment well. Looking at fees and other income, their gain on sale of loans decreased a bit. This could mean fewer loans are being sold, or that their margins on those sales are getting thinner. Last year at this time they had a huge loss here, which thankfully is gone. Total non-interest income was about the same, at roughly $5.1 million. And here's the meat of it: their income before taxes was $9.5 million, which turns to $8 million after a provision for income taxes. Diluted earnings per share came in at 1.01. Quickly looking at cash flows, cash and cash equivalents increased in the quarter. Good. Not much happened in the investment area. The best thing to see here is that there's a $275 million increase in deposits. Not bad. The company spent nearly $4 to buy back their shares. In addition to a decent business, investors also like stock buybacks. Now let's dive into the notes. These are like the fine print, and sometimes they contain the most interesting details. The main news on accounting changes seems to be around enhanced transparency, likely a reflection of increased public and regulatory scrutiny to better provide useful information for investors. They also have a securities portfolio made up of mostly US agency and mortgage-backed securities, so relatively safe. We should note they had a speculative grade corporate security offering a lower yield, which is unusual for community banks. FS Bancorp's loan portfolio is pretty standard. Commercial real estate loans, residential mortgages, consumer loans, and some commercial business loans, mostly around the Washington area. Nothing too exotic. They also had a lot of new shares to make available for the employee stock purchase plan. Good encourages ownership, and to stock options program. The company claims that their management measures expected credit losses. However, these metrics all come from third-party analysis. This gives the impression that they do not have analysts internal. It also looks like they don't want to pay to maintain their existing float, issuing as many new shares for various programs as they buy back from shareholders. Also a classic way to enrich the management team to the detriment of ordinary shareholders. The section is typical what you expect of an addendum, more details with minimal new insights for the average viewer. A lot of upcoming accounting regulation is intended to enhance transparency by improving income tax disclosures and expense disaggregation disclosures. The securities available for sale consists of almost 300 million of assets. They had 45,000 in provisions for credit losses on the held for maturity segment. All their loans receivable are BBB. I suppose people like it that their assets are largely in good standing as well. Their held to maturity debt securities were non-accrual, which means they are good for the time being. It looks like these treasury bills are for regulatory reasons. This is also the place where they say they don't have a third party to perform analysis on their assets. Ouch. Scroll non-accrual scale 3 unit ref USD 6 to 80 8 noon fractions CIDR found. I found an interesting point. It looks like all the bad loans are on non-agencies loans outside US government, which means that there is a large risk for the investor to lose some. Let's jump over to some of FS Bancorp's loans. In the equity area, they bought back some treasury stock and made available shares for employee programs. Nothing interesting in that area. Nothing particularly concerning in this disclosure. The company paid a significant amount of money for interest and income taxes. Nothing outstanding to see here either. It looks like their long-term debts all had about the same terms. This is just a risk factor description where the SEC is forcing them to talk about their problems. It's not really that interesting. Most of the risks here are related to accounting controls. Loan originations were higher and they expect better performance. This is a long discussion of the stock, so let's avoid that for now. Lastly, the legal portion of the filing, the bank's legal proceedings, will not have a material effect on the business or financial condition of the company, so it's a good thing. Again, we don't want to cover this as it's accounting and it is not interesting. Let's get into it. I feel this section will be dry and what you expect from banking types. They mostly mention things like the economy, trends of the time, and then gloss over any hard numbers about the future. As if they themselves have no impact on the outcome of the business. This is not interesting. It seems like the banking segment is sensitive to rates and economic conditions. They mention that business segments are for determining allocating resources internally and that this is dynamic, so basically nothing of use to us from the outside. The recent accounting pronouncements seem to have a big role to play. In the future, transparency is set to increase. We can skip this section as these are things the bank needs to follow and not anything you, the viewer, needs to know. Let's see what's going on with the debt and securities and credit risks. It's just a comparison of different assets with good ratings, so nothing super scary or interesting in here. Scroll stockholders equity scale 3 unit. REFD UITS 2064,488 non-fraction C. Here in the reconciliation of equity, it looks like in the previous year, stock options were exercised for a net loss and decrease in value of the equity. Nothing particularly interesting here. The debt is good and has proper backing according to the bank, and of course everything is in order. There isn't much in this section, so let's move on. It looks like a huge drop in equity that the author describes as temporary is not too concerning as many government bonds are below their purchase price. The dates for various asset and bond repayments, nothing sold. Let's move on. They describe what various loans are and their sources of truth for the value, but nothing useful. They list how some assets are used as collateral against their loans, or rehypothecation if you want to sound fancy. Looks like a lot of the gains comes from accounting trickery, which makes it more difficult to find the real value of equity. Now, this is the type of risk profile that is more typical for a bank of their size. The bank has more than enough collateral at Tier 1 and Tier 2 for potential losses in revenue. They have loans that defaulted in the last 12 months. This seems like a risk worth monitoring. This section is a repeat from higher, so we should move past it. It seems like their mortgage servicing portfolio has stayed mostly stable, and they are still making money servicing them. After reading this though, the summary is that all their loans are to people guesses in their market, which means that it isn't diversified. The risk here is that the models they use can be broken. Mortgage servicing rights are extremely sensitive to changes in key assumptions. Let's review that business segment now. These numbers are only useful for inside the firm, as they mentioned. Management's view of the company's operations. Add true. This section only adds a little information. The numbers are only useful for inside the firm, as they mention management's view of the company's operations. Add this section only adds a little information. They split the income almost equally. Home lending are the biggest expense, which comes from not having as many loans. It looks like the servicing is down on what they are earning, but let's dig deeper to see why. Their banking and home lending segments earn similar, however that all comes down to inter-segment expenses and transfers, so we can't look at that. Scroll net income loss scale 3 unit ref USD there. 526 million. From a very rough estimate, it looks like the net income for 3 months is almost identical between the two dates, 7/7 v 7 v6, so we can move forward without a huge worry. For notes about IMSR and the portfolio, you are going to get a better look at the risks here. And here, the biggest point seems to be that a rate change of 1% would lower their earnings by about that. Their financial instruments are in good order, so that's good. There isn't much that is going to be said on the final section, so let's finish up the video. This has just been an overview of their accounting strategies, so that doesn't mean too much to the average viewer. So what's the big picture here? FS Bancorp is showing slow but steady progress, in my opinion. They're managing to keep their net interest income and earnings relatively stable, even with changing market conditions, however. There are some concerning trends related to loan types and the source of value, in that their management isn't too transparent with many of the important details of their holdings. The biggest risk is the reliance on a third party for critical data regarding the stability of the firm. What do you think about FS Bancorp's spring cleaning here? Any surprises or concerns? Drop your thoughts below. If you found this analysis helpful, give us a like and subscribe for more corporate deep dives. And hey, don't forget to check out our Discord community in the description. We've got some big minds in that area. Thanks for watching, and I'll see you in the next Decode.